Hey guys, welcome back. In today's video, we are looking at why $30 is a normal price, the aggressive buying, the existence of synthetics, and many more in this video. Firstly, let's take a look at this. AMC market cap should have been up to 15 billion, 15 times the current price of $2. In other words, $30 share price is a fair value when considering the annual revenue it generates. That's without any shorts covering their massive positions. The reason why we say this is because if you take a look at the comparison of how a normal company operates and how they are valued, when you apply that same logic, when you apply that same thing to AMC, that is a number we should be getting at. We should be getting at anywhere around $4 to $15 billion market cap, which right now we are nowhere near. Now, of course, there are plenty of other factors that comes into play, but one of the things that we have always talked about for AMC is how it doesn't obey by the normal market laws, because we've seen the fundamentals, we know the revenue it generates, we know how well they're improving on their revenue, yet we never actually see it reflect on price. Right now, we're looking at a 0.2x in terms of our market cap to our revenue, but that should not be the case. And we know that we are extremely undervalued. And once again, there are, of course, other factors that come into play, whether it should be slightly undervalued or whether it should be overvalued, because of the fact that we are not including short things such as shorts covering, the synthetics, the institutions that are buying without the dark pool. There are so many things that needs to be considered, but one thing we do know is just how undervalued it is, especially when we take a look at the fact of not only do we see the revenue that AMC is currently generating, but what they have proposed, what they're doing in order to create the revenue of AMC to be even higher. Look at what Adam Aaron has said in the past. Three of my highest innovation priorities for AMC in the year 2026, more premium large format screens, up our use of AI and technology to become a more efficient company and to dazzle our guests in theaters. After years of fits and starts, secures the rights to show professional and college sporting events. So with all of these things, they correlate to, how the financial sheet is going to improve. Firstly, if we are able to get more premium screens, we're going to be seeing more and more people coming to watch. Hence, we're going to be seeing the revenue go up. When we look at AMC becoming a more efficient company, we're going to be looking at it cutting down operational costs. We're going to be looking at the profit margins going up. And of course, if we get the rights to show professional and sporting college events, we're going to be looking at even higher revenue. And one of the things I want to talk about with the use of AI is that not only would it make AMC a more efficient company, but one of the case we talked about in the past before was about talking foreign movies and how the use of AI can actually encourage more people to watch more movies, which another way of increasing revenue. So all three things here firstly correlate to the increase of revenue, with the middle one not only increasing revenue but cutting down and becoming a more efficient company, aka raising the profit margins. So not only are we looking at AMC trading at its current revenue, and we know that it's undervalued at its current revenue, but also the fact we know that AMC is actually going to improve on those revenue and make it even more efficient. So when we talk about undervalue, we're not just talking about what we are looking at right now, but we're also talking about how the future projections of AMC is extremely bright. And whereas for most companies, the price would reflect not only the current results, but what people also predict for the future, for AMC is the complete opposite. We don't get any reflections of future projections, nor do we get the correct reflection of the current stage of AMC. And that's because of all the synthetics, naked shorts, dark pool usage that's out there, and ultimately shorts trying to suppress the price of AMC. You can see AMC down 15.6% in 1 week on no bad news. What are the market makers thinking using endless share low case exemptions at 185? Every share bought at this level is a big money loser for the short seller. Make it make sense. When you take a look at the news that's going on for AMC right now, we've talked about it's pretty much how well the box office is doing. We have been seeing movies that are being released that are breaking records, that are bringing in massive numbers, whether it's Wicked for Good, whether it's Zootopia, or the upcoming Avatar. So these are all the good news. The only news that could be considered as bad news is the authorization of shares, which one could view it as dilution, which typically is something that brings the value of a share price down. However, we know for the case of AMC, it is different. Now, even when you consider that as a negative news, the amount of good news that has been released that has no impact, and then one negative news come out and we see it down 15.6%, it does not make sense, especially the fact that this dilution news that we saw should not bring AMC down 15.6% because there's a clear difference between authorization and issuance. And the big reason for why it's down is because shorts view dilution as a bad news. The reason why we say this is because allowing AMC to issue more shares allows AMC to raise more money to then make them a bigger company. And for short sellers, that's obviously a very, very bad thing. And so to prevent them from raising as much money as possible, they're obviously trying to push the price down, because AMC is able to raise less money at $185 than it is at $2, than it is at $3, and that prevents them from raising cash. You can see another news in terms of good news. We see Adam Aaron saying here, Avatar. Opening this week, Avatar Fire and Ash. Will it be the highest grossing movie released in 2025? So to really end this year, we have a huge movie coming out. And so this is what we said with pretty much we're only looking at good news, not only for the whole industry, but for AMC as well. And a news in terms of which you can take it from both perspectives, once again talking about the issuance of shares. One side, it can raise AMC money. The other side is the small dilution that it does, because we have to remember it is not issuing 550 million shares. It authorized 550 million shares, but there's a big difference in the two. And so the positive news should have trumped the negative side, yet we're seeing the negative side take control. And that really just explains what's going on within the market. That just talks about how the shorts are obviously pushing AMC down. And then if you take a look at this, why would institutions load up on AMC if we were going bankrupt? Why would they load up if they thought AMC was going to have a reverse split? Know what you hold. They want you to sell at all-time lows with fear. So one of the things that they're trying to do right now is, of course, buy as much shares as possible. The important here is buy as many real shares as possible, which is very important, something I'll talk about later on with the help of Michael Burry. But what we're looking at is how they're trying to bring AMC down. Firstly, one of the news articles we've been looking at recently is how they're saying retail investors are leaving AMC. But we know that that's extremely ridiculous, because why would apes have bought throughout the last 4 or 5 years consistently at a higher price? And now, as we see AMC on its run, as we see AMC improve, as we see more and more capital flow into AMC, why would we suddenly decide to sell? That's not the point. That is not the case. And that's what shorts want you to think. And then what they're failing to say is that institutions are trying to buy as many as possible. And that's why they keep on pushing the narrative that apes are leaving, because they want institutions to buy up. Another thing is, you can see, and this is the AMC DD right now. Pentwater Capital, one of the most aggressive derivative/event funds on earth, just revealed a 9.5% stake in AMC. This dropped days after UBS disclosed a 4,537% jump in AMC exposure. UBS plus Pentwater both going massively long at the same moment. So we're seeing institutions buy. And normally it could be, we could view it as a bait because maybe they're just buying 1,000 shares. But here we're seeing them buy 9.5% stake. We're seeing institutions buy as much AMC as they possibly could. Why would they spend this much money? 48.6 million shares being bought. Why would they buy so many shares of a company if it was going to go bankrupt, if it showed no signs of future projections that are proving its returns? So these are all understandings and proof of how well AMC is going to be, of how expensive AMC will be in the future, and they're all trying to capitalize on that. And this is why we've said there's a big difference in the articles, because they're extremely quiet about how these institutions view AMC as the golden opportunity, how they're quietly accumulating as much as possible, versus the articles that they're releasing in terms of AMC is no opportunity, AMC is a bad stock, you should sell AMC, you should stay away from AMC, and that is the reason why we know that that is not the case. Furthermore, what we can see is Michael Burry discussing naked short selling in his GameStop story. So over here, he talked about GameStop, but we know that it carries over to AMC as well. And is why I said earlier why the real shares of AMC is extremely important. So first we have to understand before I go into this, we know that the real shares are being held by the retail investors. Institutions have been trying their hardest to buy the real shares, which once again, held by the retail investors. Is why we see articles constantly saying that retail to sell their shares because they want the retail to sell the real shares. Firstly, they talk about, Michael Burry talks about, how short sellers try and tag their stock. Now, for this, we have to understand how it works in terms of the legal layering of trade. So when the stock is borrowed from an owner and shorted to a buyer, who then in turn lends the share for shorting, a cycle is created and repeated. And if demand for shorting is high, the cycle will become a fairly elegant and long sequence. Most of the exposure in that chain/sequence are actually synthetic positions. So this is Michael Burry already talking about the existence of synthetics. This is something you already know, but this is coming out of Michael Burry. Sounds terrible, does it not? But it's all perfectly legal and correct. Every one of the transactions in the sequence is recorded and properly settled. The wiring of the market deals with this just fine during normal times. And here's where the most important part comes in. It will take a very big volatility event to upset that apple cart. The humans working on this are not idiots. GameStop was unprecedented though. All that layering, all the synthetics had to be unwound with the urgency at the same times. The beautiful sequence broke down. Dealers have temporary exemptions to be nakedly short, which is also not usually a problem, but for when a correlation event like GameStop happens, that is what's happened with GameStop. All that cool buying by retail created the aforementioned gamma squeeze, and the layering becomes a mess. It was resolved by panic buying. Now, professional fund managers and short sellers were caught in this way. Identifiable real shares became scarce, and the urgency to cover grew. So these are the important parts. First, we have to realize that all of these synthetic shorts, because of the complex system, that's the reason why they're able to exist. They're not normally broken, but when faced with extreme volatility, they can be broken. And it's why we see AMC, why we see GameStop go up during those times. The only way for short to get out of this whole thing, for them to firstly stop it when it happens and prevent it in normal times, is by having these real shares that becomes scarce. So this is why we understand that these institutions, that these short sellers want real shares. And here hopefully makes it understandable for why we talked about the importance of real shares. Why institutions, why these media articles want apes to sell their shares, because apes are in hold of the real shares of AMC. And that's what they're trying to do. You can see concrete results but zero impact on price. The narrative is what drove things. And he talked about why stock price is not the business, and that AMC is going to prove a lot of people wrong. And so from over here, you should already understand what is going on within the market. So as we talk about this, you can see naked shorting, you can see synthetics once again when it comes to stocks that are in the limelight, that are facing volatility. Firstly, brokerage firm TradeStation recently told their customers they can no longer transfer the MMTLP shares customers to AST because they no longer have the shares to transfer. And so this talks about the existence of counterfeit shares that are in MMTLP. And so you can understand, for a company that is smaller than AMC, that are facing with counterfeit shares, are already struggling, you can only imagine when it comes to AMC, when it comes to GME, just how serious the situation is. It doesn't stop there. Genius Group, his record fails to deliver when trading resumed after suing Citadel. You can see GNS stock surged 80% in pre-market trading, then reversed sharply and dropped to 0.67. Now on that day, it shows 5 million FTDs, pure corruption. So this is what we talked about with how they're using these tactics to suppress a stock, but how these very tactics are then exposed and we know exactly what's going on. The frustrating part about this is, despite the fact we have evidence all over this, despite the fact we have people like Michael Burry, Charles Payne, who are extremely vocal about this, we're not seeing the people who can actually have an impact do anything about it. We're taking a look at SEC, we're taking a look at FINRA, the regulations are doing nothing about it, despite the fact we're showing proof. Now, when you take a look at the technical analysis, what we just talked about for GME as well, bullish moving average crossover into a bullish MA flag, coming to you in Jan 2026. So we're looking at how well GME has been performing recently, and we're seeing the technicals line up as well, especially with what's going on is starting to make sense. Another thing, GME warrants are up more than 8% on no news. Strictly fundamentals that GME has had 6 profitable quarters in a row. So we're becoming to see how these warrants are becoming more and more valuable. Now, there's a big reason is obviously because these are essentially call options for GME. And the reason why we see it go up is because firstly, we already saw the fails to deliver. But secondly, it's about, once again, the need for GME shares, the need for AMC shares. And it's why we see things like this go up. This doesn't technically have a direct impact on the price of GME, but it shows the demand for GME shares, because if the warrants go up, meaning more and more people are buying more warrants, it would also mean that they want more shares of GME. So this is what we are looking at. Now, let's take a look at how the short sellers are actually doing. So firstly, BofA, Bank of America, is short 44.7 billion worth of silver with an average price around $25 to $30. Silver is currently at 64. Now, why is this important? Well, firstly, you have to understand is that this is clearly affecting Bank of America. Anyone understanding how short positions work will know that they're losing money, and they're losing a lot of money. When you have a position that's worth 44 billion, and you're you're seeing the price at 64 when your average is 25 to 30, you are losing a ton of cash. And this cash affects short sellers because Bank of America is the prime broker and lender towards companies like Citadel. So if we're going to be seeing them struggle with these positions, if we're going to be seeing them failing to meet the requirements, and if we're going to see them fail to have capital, we're going to be seeing companies like Citadel struggle as well because they can't borrow cash from Bank of America. And at times like this, when we're seeing how well AMC is doing, when we're seeing how more and more people want AMC, you start to see why it's a problem. Another thing is understanding the entire market cap. S&P 500 stocks is 57 trillion right now. Yen carry trade is 20 million. This does not include over leverage on AI stocks. We talked about yen carry trade for a long time now. We talked about how if it happens to corrupt and collapse, we can see the entire S&P go down. Now, when you take a look at how much of the yen carry trade is worth and how much the S&P is worth, you start to see why. You start to see why it becomes a worrying problem. When you take a look at the reverse repo, it jumped up to 10.36 billion. This is very important because this isn't suddenly a sign of the short sellers are getting saved again. No, the complete opposite. This is short sellers are really struggling and they're begging for capital. And this makes sense because we see the yen carry trade. We see how Bank of America is struggling. So it's no surprise we're looking at the reverse repo go to 10 billion. When you take a look at the derivative positions, we talked about this in the past before, but you understand why this is so big. JP Morgan and Chase at 63 trillion, Goldman Sachs 56 trillion, Citibank 56 trillion, Bank of America 27 trillion. Once again, these are in trillions. So this is what we've said with, if even one of these firms break down, the whole market is going to go into shambles. And then the final thing, US bankruptcy are running at a recessionary pace. US large bankruptcies have hit 717 year to date, the highest level in 15 years. So this is what we've said with how bad the market is right now, with how much problem they're going on. And so when we talk about shorts are struggling, this is the reason why. As always, now this is Financial Advice, so do take us a grain of salt, make sure to do your own due diligence and research, and I'll catch you guys next time.